Welcome to this special analysis roundup by the North Carolina Local Government Budget Association. Today we are focusing on unemployment insurance fund solvency, the changes implemented as a result of House Bill 4 that was adopted earlier this year by the General Assembly and signed in by the Governor. We'll look at the program changes with respect to how local governments will pay for unemployment insurance and their impacts on local governments' 2014 fiscal year budgets. I'm joined today by Karl Knapp, Director of Research and Policy Analysis for the North Carolina League of Municipalities. Karl, thank you very much for joining us today.
You're welcome, Kenneth. Glad to be here.
Karl, before we begin, let's take a quick moment to look at what exactly unemployment insurance does in North Carolina. Overall, it is a federal and state partnership where the state pays 100% of regular benefits and the feds pay 100% of emergency benefits to those who are unemployed, and then extended benefits are split by the feds and the states 50-50. It is funded through private employer payroll taxes, as well as governments and nonprofits are then given the option by the state, as under current law, of either directly paying reimbursement of claims or an experience rate, but they do not pay the federal payroll taxes that are paid by private employers.
We got a couple of questions in regards to this. First of all, if you don't mind, briefly explain the logic behind the General Assembly's decision to apply this new reserve requirement to local governments. This is something that's different than what's been done in the past. Can you briefly explain the logic?
Yes, the state is deeply in debt to the federal government for unemployment insurance funds as a result of the recession. The state private sector tax rates for unemployment insurance were very low during the boom times, and so when the recession hit, we did not have much of a balance in our fund and had to borrow money from the federal government. That borrowing is now getting ready to come due, and when as long as there is a debt at the state owes the feds, it's going to increase private sector tax rates. And in an effort to try and prevent that, the legislature has worked out a plan to accelerate repayment of the debt through some surcharges on the private sector, and through an effort to both put some money into the fund to beef it up and to create a reserve that local government benefits will be paid out of, so that the interest that is needing to be paid during the time that those claims have been paid by the state is coming off of the reserve money that the locals have put in rather than out of the state share of it. So the requirement on local governments is largely out of a fiscal consideration for the state.
I understand. And obviously this changes the way that local governments make their payments with respect to unemployment insurance. In the past, they've been making direct payments, and in fact, they will still have to make a direct payment in 2014. That is correct?
That's correct.
And so in addition to the direct payment to pay back what was paid on their behalf in 2013, fiscal 13, they're also going to have to be making this now reserve payment. How will those payments be made, and who will they be making those payments to?
Okay. But first, let me clarify that the last direct payment will be made during 2013, and it will be in addition to these reserve payments. The reserve payments that we're making will be similar to the way that the nonprofit sector currently makes payments. Each quarter, local governments have already been filling out the UI 101 form that lists each of your employees, their wages for the quarter. And for private sector entities, there is a calculation in there that compares those wages paid in the quarter to what is known as the taxable wage base. That comparison and calculation will be essential in determining what local governments will pay under this, and it will be done each quarter for one fiscal year. The quarterly payments will only be made October of 13, January of 14, April of 14, and July of 14, all of which would be booked to the 13-14 fiscal year. The payments, as I said, are based on what the taxable wages paid up to that taxable wage base are in any quarter. The taxable wage base is an amount that is set based on prevailing wages in the state. For 2013, it currently is $20,900. Because it's based on prevailing wages, it does increase from year to year. We have been advising people that for 2014, it will probably be $21,400 based on prior experience.
And that is a calendar year-based wage, correct?
That's correct.
Okay.
So when local governments are making their payments for that October payment of this year, they will be looking at each employee that they have and how much that employee was paid during the calendar quarter, July to September, and how much they have been paid prior to that during the calendar year. If prior to July, September, they have already been paid $20,900, then there would be no reserve payment due for that employee during the third quarter. If, however, prior to July they had been paid less than $20,900, then they would be paid, then the local government would be paying 1% in the third quarter of the difference between, because you pay up to that $20,900 amount based on that. Let's say you have an employee who made $20,000 during the first half of the year, and it's based on when the employee is paid, not when the money is earned. But they had been paid $20,000 through July, so they would be paid about $10,000 in that third quarter. Only $900 of that $10,000 would be subject to the 1% reserve payment, because it's the only portion during that gets between the $20,000 they've already been paid and the $900 that remains in the taxable wage base. So for that employee, their taxable wages during the third quarter would be $900, and the reserve payment on behalf of that employee would be $9. When that employee got into the fourth quarter, they would have no taxable wages because their wages had already reached the wage base in the previous three quarters, and there would be no reserve payment necessary. Because it's on a calendar basis, when you get into the January to March quarter, everything that's happened in 2013 is ignored. So that first $10,000 that employee is paid in January to March is all under the taxable wage base, and the city would pay 1% of that, so $100. Similarly, in the second quarter, all $10,000 is under the wage base because the sum of the first two quarters is less than $21,400, and the employee, the reserve payment for the employee would be $100. So you would be paying $200 during calendar 2014, $9 during calendar 2013, for a total payment of $209. This is going to be the case for many of your employees. There's going to be some employees who make enough that they would have to pay a little bit more, up to the $214,000 or $214 each, but by and large it's going to be somewhere in that range. For employees whose annual wages are under $2,900, a local government would need to budget 1% of that employee's salary as the reserve payment during 2013-2014.
So again, and that was $20,900 being the threshold?
Yeah.
Okay. And following up to that, in terms of when local governments are planning this, and we can do salary projections that can kind of give us an exact idea, but should we consider potentially adding, say, a 5% contingency in making sure that we can fulfill this obligation during the course of the budget year?
Yeah, you're going to need a contingency for several reasons. If there is a mid-year budget adjustment to add positions, that would increase your wage base. Probably, though, if you do that, you're going to include that as part of the budget amendment, so it may not be that important to do it up front. but the effect of turnover on this can be pretty significant. Because the calculation is based on the employee, not the position, if you have an employee leave during the second half of the calendar year, then it's going to have a fairly significant effect on your amount that you owe depending on when they leave. For example, let's go back and look at that employee who's making $10,000 a quarter. If that employee has worked 2013 through July and then departs and is replaced, say, at the beginning of October by another employee making the same amount of money, the wages that the former employee earned are not considered when determining the amount of money that has to be paid into the reserve for the new employee. When the new employee starts, the $10,000 that they earn in the fourth calendar quarter of 2013 is fully considered taxable wages. And so that $10,000 the local government would have to pay 1% of. Then again, it would pay the same way January through July as it would had the employee been in place all the time. So the payment for that employee will be $300 instead of $209. So local governments need to take into consideration their rate of turnover and when that turnover occurs, and what their gap is generally in filling positions. If you have turnover in the fall, then when the new employee comes on board, all of their wages for that calendar year will be taxable. If an employee departs between January and June, it will actually potentially reduce the amount that you have to pay in because whatever period of time the position is vacant, you'll have a gap in the amount of taxable wages being paid. So it really does take some thought as to whether there's any cyclical pattern to when your employees depart. If you've got low-wage employees who tend to depart during the holiday season in order to take better-paying retail jobs, it's probably going to have some effect on your taxable wages at that point and cause them to go up and therefore cause your reserve payment to go up. But if your vacancies tend to happen on a fairly even pattern throughout the year, it's probably a little bit easier to figure out what kind of contingency you need to build in for vacancies.
Okay, thank you. For those of us who aren't necessarily familiar with filling out unemployment insurance, from the standpoint, does this taxable wage requirement apply to full-time positions only, or does it apply to both full-time and part-time positions?
It applies to full-time and part-time positions and to any temporary and seasonal employees that you have who are directly employed by the government. If they're hired through a service, then it's the service's responsibility to handle their unemployment. But if they're employed directly by you, then you're on the hook for making reserve payments and eventually making paying any claims that they would make. So for most seasonal and temporary employees, you probably are not going to pay them during the course of a calendar year more than the taxable wage base. So for those employees, you're probably going to be best off just budgeting 1% of their wages as the reserve payment.
Those answer some key questions there with respect to these changes. And I guess to finish up this conversation, are there any other specific concerns that you believe local governments need to be prepared for as they are going forward and implementing this program?
I think that the most important thing for local governments to do is to make sure that they understand that UI 101 form. There are paper and online versions of it. Someone in your organization has been putting information into it already, whether it's out of HR or payroll, depends on the individual jurisdiction. They may not have been completing it in the manner that's necessary to fully determine what your wages are, but the Division of Employment Security at the Department of Commerce, which used to be the Employment Security Commission, their tax staff has been very welcoming of bringing local governments into the system and wants to provide assistance to make sure that everyone does this well. You want to get your reserve payments right because if you come up short, then your annual billing is going to be bigger than you expected. The way that's going to work is that after you've made these 4 quarterly payments, the Division of Employment Security will determine what your wage base is. They will then deduct claims in 2014 from that reserve and determine how much you have to pay into it to bring your reserve back up to 1%. And that will be an annual process from there on. The amount of your reserve will only change as your number of positions increase or decrease, as your local pay adjustments for COLAs or merit increase the pay of workers whose pay is below the taxable wage base, and as the taxable wage base itself increases year to year, it will bump up the size of your reserve a little bit. But basically, in the long term, the amount that you're paying will not be a lot different than what you've been paying annually just to pay off your claims. It's just that you'll be replenishing this reserve so that the state has money in the bank to pay those claims rather than bringing down its cash balances to pay claims and then getting you to reimburse them.
Okay, so in following up to that answer, 2 questions. First of all, what you're saying is that we should only expect to have to make these quarterly payments for about 1 year, correct?
That's right. You will make 4 quarterly payments, all of which would need to be budgeted for 13-14.
And
after that, it's an annual process.
And that was my other comment. I'm assuming that the LGC has said that the July payment will need to accrue back to fiscal 14, correct?
Yes, that's right, because they are related to wages paid during that period of time. And I want to reiterate that the budgeting for this is based on when the payments are made. So you have to look at your own payment cycle, and if you've got merit increases or COLAs that take effect as of a certain date, you have to factor in when the first payment that reflects that is in the budget. Because if it's if you've got a July, I'm not sure, July 1 pay increase, but it doesn't actually take effect in people's paychecks until what they get paid in August, it's going to have a little bit of an effect on that. So you have to look at your own cycle to make sure that you're timing any pay increases appropriately.
Okay, and also that means that when you're talking about the payment, that means that, for instance, some jurisdictions pay the final 2 weeks of June. They typically pay that in July. That means that that final payment would not count towards this, correct?
That's right. So
okay.
If you're looking at what your employees have been paid January through June to determine whether they have been paid up to the taxable wage base during that time, then those last 2 weeks, if they get paid in July, don't count. But presumably your last 2 weeks of December got paid in January, so it may even itself out. It really has more of an effect as to when pay increases take place.
You definitely recommended talking with the Department of Employment Security, the Division of Employment Security, which is part of the North Carolina Department of Commerce, and that their staff can provide assistance.
That's probably their best sources. If you've got questions about from your finance staff about how to handle these payments on the balance sheet, the LGC will be providing that advice. They, at this point, do not have a determination on that because they are waiting for the state controller to determine how these prepayments will be handled on the state's balance sheet, and then that will determine how they're going to be handled on local balance sheets. But one other point I wanted to make related to timing is retirements. Given that some employees, when they retire, have a significant amount of wages that they are getting through accrued vacation, that those payments are going to fall and be part of their wages for the purpose of determining the taxable wage base. So if an employee retires at the end of December, they will still have wages in the next year if they're being paid 2 weeks after they retire, and you're going to have to take that into account when calculating your taxable wages.
Well, Karl, thank you very much for providing some guidance and some understanding of a very complex issue. Obviously, no issue is perfect in terms of its timing, particularly as we're getting ready for budget, and we also know that you have a very busy schedule with the legislature being in session. So thank you very much for taking this time to talk to us about this, and we look forward to seeing you at our summer conference in July in Wrightsville.
Thank you very much. I'm looking forward to it.